All right, let's dive into how we can tame the Kelly Criterion for practical position sizing. Just a quick heads up before we get started, this is all for educational purposes, it's not financial advice, and you know that all trading involves risk. Okay, let's get to it.
So you've got a winning strategy. That's awesome. But here's the million-dollar question. How much should you actually risk on each trade? This is like the fundamental problem every single trader has to solve. You could have the best system in the world, but if your sizing is off, you're either leaving tons of money on the table or you're one bad streak away from blowing up. It's that serious.
For decades, some of the smartest people out there, mathematicians, pro gamblers, investors, they've all wrestled with this exact problem. And their search for that perfect, optimal mathematical answer led them to one very specific and, very powerful formula.
And it's called the Kelly Criterion. Now, on paper, this thing is the holy grail. It literally promises to tell you the exact percentage of your capital to risk on a trade to make your account grow as fast as mathematically possible over the long haul. I mean, it's pure optimization.
And the formula itself looks deceptively simple. All you need are two numbers you should already have, P, which is just your win probability, and B, your average win-to-loss ratio. You plug those in, and out pops F star, the supposedly perfect fraction of your capital to bet. Seems almost too good to be true, right?
Well, yeah. This is exactly where theory slams headfirst into reality. Because while it might be mathematically perfect for maximizing your growth over like an infinite number of trades, using the full Kelly formula in the real world can be an absolute catastrophe for your account.
And here's the problem in a nutshell. The dream of Kelly is this beautiful, smooth, maximum growth curve heading to the moon. But the reality of betting the full Kelly size is a violent, gut-wrenching roller coaster. The math promises long-term riches, but it completely ignores the short-term psychological pain of watching your account get crushed by huge drawdowns. You might go broke before the long-term ever shows up.
So why is it so dangerous? Well, three big reasons. The variance, the swings in your account, is just extreme, and the short-term journey can be absolutely ruinous. But the biggest trap of all is something called estimation error. See, the formula assumes you know your trading edge perfectly, but in the real world, you don't. You just have an estimate based on past trades. And if your estimate is even a tiny bit too optimistic, the formula tells you to bet far, far too much money.
So what's the fix? Luckily, legendary investors like Ed Thorpe figured out a practical solution. And his insight was just brilliant. By simply cutting the recommended bet size in half, you still capture about 3/4 of the maximum growth, but you dramatically reduce the odds of taking a catastrophic loss.
This is it. This is the key. Half. Such a simple adjustment, but it transforms a dangerous theoretical formula into a robust, practical tool for managing risk.
Now, this isn't about being scared or leaving money on the table. This is the professional approach. Traders and fund managers who use Kelly almost never use the full amount. They use a fraction of it, most often half, sometimes even a quarter, to build in a margin of safety against all the things that can and do go wrong.
So this gives us a really simple rule of thumb. If you are extremely confident in your strategy and your data is solid, think of half Kelly as your absolute ceiling, your max bet size. But if you're in a situation with more uncertainty, a new strategy, or maybe you have a bunch of trades that are all correlated, it's much smarter to be even more conservative. Start with a quarter Kelly, maybe even less.
Okay, so that's the theory. Now let's actually build this into a practical action plan that you can use.
Here is a super simple exercise you can do. First, calculate your full Kelly number based on your trading history. Then run a quick simulation. You can do this in a spreadsheet. See what your worst drawdown would have been using full Kelly, then half Kelly, and then quarter Kelly. The results will probably blow your mind and show you exactly why a fractional approach is so much safer. Then you just pick the fraction that leads to a drawdown you can actually live with.
And as you're doing this, please avoid these common traps. Don't base your calculation on just a handful of trades. That's not enough data. Don't forget that if all your positions move together, your real risk is much higher than you think. And never, ever assume any sizing model is totally safe. You always have to be thinking about the worst-case scenario.
If you walk away with just one thing from this, let it be this right here. Optimal position sizing is not about being greedy. It's about survival and steady, long-term growth. Treat half Kelly as the absolute maximum you would ever risk on a trade, and it's probably better to start even lower, especially when you're not 100% certain.
So I'll just leave you with this question to think about. Based on everything we just covered,
What is one simple adjustment, one little test you can run on your own strategy, like right now, to make sure your position sizing is tough enough for the long haul?
Thanks for watching. And remember, this content is for educational purposes only and is not financial advice. Markets involve substantial risk, including the loss of your money, and past performance is never a guarantee of what will happen in the future. Always, always do your own research.